प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Nifty ends below 8,450 as market halts 7-day winning run. Realty, FMCG, banks drag. IRCTC nosedives over 1,400 rupees in trade after market cap tops 1 lakh crore rupees. The stock is, however, up over 1,700% in 2 years of listing. Government likely to remove existing fare caps on airlines. Business Today TV exclusive that the announcement is likely by the end of October. Zomato in hot soup finds itself sandwiched between the Tamil-Hindi divide in Chennai. Founder Dipinder Goyal puts his foot down, calls out intolerance in a tweet. And a special report on the craze among Indians for SUVs. Clear favorite among customers, hatchbacks and sedans left following in the dust. Markets witnessed some profit booking in trade today after 7 sessions of gains. The Nifty touching a fresh live high of 18,604 in early trade, but coming off those highs to close at about 18,418. Down about 0.3%. Sensex also closing at 61,716. That's down about 50 odd points for the day. Profit booking in metal, FMCG, PSU bank shares dragging the benchmarks lower. Top laggards today. ITC a 6% knock coming in. Tata Motors, iShares, a couple of those auto majors cooling off. Definitely we saw the kind of gains Tata Motors saw last week. HUL continuing to look a little weak in trade, and Titan also seeing some amount of profit booking setting in. Gainers, Tech Mahindra bouncing back. We had L&T, Infi, Kotak Bank and Bajaj Finserv, some of the names on the upside in today's session. Broader markets unperformed and the S&P BSE mid-cap and small-cap index ended the session lower, both close to about 2% respectively. The shares of Tata Power, IRCTC, IDBI and Oberoi Realty all cracking in trade, down between 7 to 11% on profit booking. Remember, shares of IRCTC are up nearly 300% in the last 6 months. Among sectors, Realty, FMCG, PSU, metals, all of these worst hit. FMCG giant HUL or Hindustan Unilever reported healthy Q2 earnings. The performance was broad-based with all divisions growing and competitively. Home care up 15%, beauty and personal care up 10% and overall volumes also growing by 4% in the July to September quarter. The company reported an 8.86% year-on-year rise in standalone net profit. This was on the back of sequential improvement in trading conditions, according to Chairman and MD of HUL, Sanjeev Mehta. The earnings are before interest, tax, depreciation and amortization or EBITDA for the said quarter came in at 3,132 crores. That's up 9.2% on a year-on-year basis. EBITDA margin, meanwhile, was down 40 basis points year-on-year to 25%. This downfall was also aided by the consistent rise in input costs via increasing raw material prices. IRCTC Express, which was running amok, was brought to a halt today. The stock plummeted 15%, that too after crossing 1 lakh crore in market cap earlier in trade. Investors pulled the chain and shares witnessed a slump of 1,400 rupees. The state-owned entity entered the market in 2019 and since then the stock has soared 19.7 times the IPO price. The dominant player in the rail travel market has seen a growth of over 275% in the past 1 year. With COVID cases on the decline and vaccinations nearing the 100 crore mark, IRCTC's rally has only accelerated. Good news for Indian banks, with international rating agency Moody's revising their outlook to stable from negative. This comes just days after Moody's revised India's sovereign outlook and also those of individual banks. Moody's cited a stabilizing asset quality and improved capital drive among other reasons for the change in outlook. The upgrade will make international borrowings cheaper for banks and also displays greater confidence of global financial institutions in the Indian banking system. With the government removing restrictions on domestic flights, allowing airlines to operate at 100% capacity from this week, attention is shifting to another issue. the removal of the existing fare caps, the minimum and maximum fares that airlines can charge for domestic flights. Government sources have told Business Today TV that the fare caps are most likely to be removed with effect from this month end. Karishma Asudani joining us on the story. Karishma, we've heard several times in the recent past airfare caps would be removed as capacity and demand were rising. What's the latest on this front now, and what happens to airfares?
You know, Abha, the Indian aviation sector is on the verge of a turnaround, and sources tell this to Business Today television that while the capacity restrictions have been removed, now government is looking likely and expected to remove the fare cap on prices for domestic aviation, and that's going to happen as soon as before the winter schedule kicks off, which is going to be on October 31st. That is just next week. Let's understand this, that passenger traffic is been soaring high and has immensely shot up in last few months, and that's not just because of successful vaccination, but also the fact that consumers are now trusting air travel back. If we talk about the impact on removal of price caps, we do not know how likely that it's going to cause a major big impact, because you also see the festive season is around the corner, and that could be based on the demand as per routes.
Thanks for that, Karishma. Now, in a major setback for IPO-bound ride-hailing app Ola, its COO Gaurav Porwal and CFO Swayam Saurabh have both decided to exit the company. This comes even as Ola plans to list on the Indian bourses. Ola CFO Swayam Saurabh is set to leave the company in December, while COO Gaurav Porwal, who ran the mobility business, is also on his way out. Post the resignation, Ola CEO Bhavish Agarwal has announced major management rejigs, with Vinay Chawla and Anshul Khandelwal getting additional responsibilities. Small hatchbacks and sedans have always been leaders in the Indian car market, but now their supremacy on the roads is being challenged by SUVs. For the first time ever, SUV sales have outnumbered cars in September, and the writing on the wall is clearly being read by car manufacturers.
With SUVs driving the comeback of India's auto industry after pandemic blues, car makers are rejigging their portfolios to offer more SUVs to the Indian buyer. This festive season has seen a slew of SUV launches, some new and some variants of existing models. Already an SUV major, Tata launched the Punch with an eye on capturing the small SUV market. This was preceded by Mahindra, which has bet big with its XUV 700, garnering over 50,000 bookings within days. Other entrants are MG, which launched its fourth SUV, the Aster. Force Motors has relaunched the Gurkha. Volvo lifted the veil of the mild hybrid version of its XC60 SUV, while Maruti has hinted that it will soon bring its Mini 4x4 Jimny to India.
SUVs as a category has grown phenomenally in India and the world over. The share of SUVs has more than doubled in the last 5 years. Today, they account for more than 40% of the overall Indian passenger vehicle market. There are several reasons why SUV as a category is seeing this consistent growth in India. One of those can be attributed to the rising aspiration of the Indian consumer.
We have a lineup of 23 vehicles planned by 2026, of which 9 are new exciting SUVs. And with that, we are all set to lead the core SUV segment in the country.
The growing craze for SUVs has led to their sales booming past other passenger cars. With close to 88,000 SUVs being sold in September, hatchbacks and sedans have taken a back seat. This is the first time ever that SUV sales have crossed the combined numbers of hatchbacks and sedans. So why are Indians in love with SUVs? The fall in prices over a period of time is making SUVs appealing for the consumers. High ground clearance and better water wading capability makes SUVs more suitable for Indian roads. The butch image and a robust design also plays a role in Indians falling head over heels for the vehicle.
The big concern is that SUVs are the most polluting vehicles. But with automakers now shifting to the BS6 engine, this argument looks a bit jaded. And for those who really love SUVs, the automakers are giving you an SUV with the electric option. With Suchita Kumar, this is Aishwarya Paliwal reporting for Business Today with camera person Sanjay Kumar.
The strategic sale of Air India to the Tatas is not just government getting rid of a bad asset. It sends out a real signal that the government is very serious about its disinvestment effort. All eyes are now on the two big ticket sales, that of LIC and Bharat Petroleum.
Air India returning to the Tata fold, the lift off markets and the industry need in the post-pandemic gloom, an assurance that the government is true to its word and has the political will to really go ahead with the sale of few select public enterprises.
Well, the government had set a disinvestment target of 1.75 lakh crore, and though there was some kind of skepticism earlier, looks like the tables have turned now with Air India going back to Tatas. In fact, so much so that analysts around are saying that the target could go well beyond what was announced in the budget.
The big daddy of them all is LIC. A 10% sale in its equity is expected to yield around 1 lakh crore rupees for government coffers. The government is expected to offload its entire 53% stake in fuel major Bharat Petroleum for an estimated 75 to 80,000 crores. Other companies on the list are Concur, Shipping Corporation, Pawan Hans, Central Electronics, 2 units of SAIL, SSP and DISP, BEML and Neelanchal Ispat.
We are well on our way. EOIs have been done, bidders are there, they're actively participating, and very soon we should be able to give the RFPs for financial bids for several of them.
That's not all. Faced with a massive revenue shortfall and coupled with a mounting social schemes bill during the pandemic and increasing frustration among the middle class thanks to the rising fuel cost, the government is stepping on the gas to monetize its assets. For instance, the 2 iconic Air India buildings, not part of the sale to Tatas, will be monetized to reduce the 40,000+ rupees debt on the company.
There are large numbers of assets which have economic value, which the government owns. Not every one of them, of course, can be monetized, but there are large numbers of things. For example, lands may have been acquired for some purpose that is no longer valid, or there may be a piece of asset that has better managed through a PPP scheme. By the way, monetization is not, unlike privatization, which is a clear thing, which is you take an asset and you privatize it. Monetization can be done in many shades of grey.
The markets, meanwhile, are celebrating the government's resolve to hive of non-core companies and use the non-debt route to reduce its deficit. While the sensex has grown just 3% in the past 1 month, the BSE's PSU index has shot up 10%.
What is more significant to me at this moment, and I think for Indian stock markets also, it gives us confidence that the strategic disinvestment has started playing. And to me as an Indian, we could have saved 1 lakh crores of rupees if we had not nationalized Air India.
Tough on its resolve, the government will also have to steel itself for political opposition as it gets ready for the big sell-offs. Elections in 5 states, including the bellwether Uttar Pradesh and Punjab, are due by March 2022, leaving the government with little political leeway. Bureau Report, Business Today TV.
Food delivery company Zomato landed in hot soup after one of its employees told a customer that he should know Hindi. This caused a storm on Twitter with "Reject Zomato" trending after users slammed the company for imposing a language on its customers.
Wake up and smile, karna sama fresh life ma, inor naal banda live it up ma. Summa sama Zomato, summa sama Zomato.
Zomato faced a lot of backlash on Twitter after one of its customers, Vikas, took to social media to complain that one of the app's customer services executives told him that everybody should know a little Hindi. saying that it was the national language. The incident happened in Chennai and the backlash to the social media post was immediate, with anger peaking over the Tamil versus Hindi issue.
Wake up and smile, karna Zomato, Zomato.
Where you buy one and you get one friend. Let's see how it goes.
Zomato was soon forced to issue an apology, stating that the employee had been terminated, reiterating that his behavior was not in line with the company's protocols.
A message from Zomato.
However, within hours, the company did a complete U-turn, with the Zomato founder tweeting that the employee has been reinstated, saying that the level of tolerance and chill needs to be much higher in the country. Zomato founder and CEO Deepinder Goyal further questioned how an ignorant mistake in a support center of food delivery company became a national issue.
Due to a customer support agent's ignorance who asked a customer to go ahead and learn Hindi, claiming it to be the national language of India, Twitter was set on fire with the hashtag #RejectZomato. The concern, however, fired the agent earlier but reinstated her, saying that this is a matter of sensitizing people. With Video Divyan, Pramod Madhav for Business Today.
A bankruptcy court in New York has dismissed a petition filed by fugitive diamond merchant Neerav Modi and his associates seeking dismissal of fraud allegations against them. The allegations were made by Richard Levin, the court-appointed trustee of three U.S. corporations, Firestar Diamond, Fantasy Inc. and A. Jaffa, indirectly owned by Neerav Modi previously. Levin had also sought a minimum compensation of $15 million for the harm suffered by the debtors of Neerav Modi. The accuser had alleged that Neerav Modi ploughed his profits back into the companies as additional sales to raise their valuations. The last of the big US-based social media companies has exited China. Faced with increasingly draconian rules, Microsoft has announced that it's pulling the plug on LinkedIn in Chinese and replacing it with a bare-bones job search site.
7 years after it set up office in China, LinkedIn finds itself singed with the dragon's regulatory fire. The professional networking site, owned by Microsoft, has announced it will leave China by the end of this year. In its place will remain a much smaller version called InJobs, which will focus only on jobs and not include social feeds or share options. In a statement, LinkedIn said, while it has found success in helping Chinese members find jobs and economic opportunity, it had failed to replicate the same level of success in the more social aspects of sharing and staying informed. It added that it was also facing a significantly more challenging operating environment in China.
The Chinese Communist Party wants everyone to obey Chinese territorial sovereignty. That is, today data is also seen as part of sovereignty. They have put up all these restrictions and trying to territorialize their data. And President Xi Jinping has been addressing the Wenzhou meetings on information sovereignty or data sovereignty.
Other American social media platforms like Twitter, Facebook and YouTube are already banned in China, and LinkedIn's presence behind the Great Firewall was closely watched as a model for how a Western social media app could operate within China's tightly regulated internet. China has intensified its crackdown on internet companies on areas from content to customer privacy. The Chinese government has also said it wants platforms to more actively promote its core socialist values. LinkedIn has already paused new sign-ups in China this March, saying that it was working to be compliant with Chinese laws. 2 months later, it was among 105 apps accused by China's top internet regulator of illegally collecting and using personal information and was ordered to make rectifications. Currently, Microsoft's search engine Bing is the only major foreign search engine accessible from within China. Bureau Report, Business Today TV.
That's where we leave it on the show today. Thanks so much for watching.